Now we're going to look at the theory around the changes in estimates component of IAS 8. There's a whole bunch of examples of estimates that may or may not change. First of all, your allowance for credit losses surrounding bad debts. Okay, your inventory obsolescence may have some estimates in it. Fair values of financial assets and liabilities have estimates in it many of the times. Your warranty obligations, useful life of assets, residual value of assets, and change in depreciation method of assets. Those are all required by IAS 16 to be estimated every single year. Okay, people often get confused with depreciation method. So if I change from, let's call it a straight line method, to a reducing balance method, majority of you out there are going to go, oh, that's an accounting policy change. I'm going to tell you you're wrong. It's not a change in accounting policy. It's an estimate of how the future benefits of that asset are going to be used. It's therefore an estimate. And if I change from straight line to reducing balance, it is a change in estimate, not a change in accounting policy. Okay, and it must be done prospectively, therefore. Okay, and provisions have changes in estimates all the time. Now, a change can occur as a result of changes in circumstances and judgments used to get to the estimates in the first place, and any other uncertainties that are inherent in business activities. Businesses change from day to day, year to year. Your business environment, the legislative environment in which you operate changes. There's a multitude of reasons that can cause estimates to change. Just please note, the revision of an estimate does not apply to prior periods. It's not a correction of an error. Okay, it's changing and updating your estimates from this year going forward. When it is difficult to distinguish between changes in accounting policy as well as changes in estimates, assume it's a change in accounting estimate then. Okay, but you need to be on top of that. You can't just say, oh, I don't know estimate. Okay, a lot of the time it is very clear, but you might not be aware of all the underlying theory. So make sure you know your stuff before you go down this road. The big thing here is that changes in estimates are recognized prospectively, please. If they are included in profit and loss, it must be done in the period of the change as well as future periods. And here, I want to just quickly think about two very loose terms. You can either do that using the spread method, or you can take all the prior year's changes based on the new estimate. Okay, you can't go into prior years. You've got to pass this year going forward. You can either spread it out, or you can take all those differences and do a cumulative catch-up. Some standards, like IAS 20 on government grants, require only cumulative catch-up. Okay. If the change affects assets, liabilities, or equity, you must adjust the carrying amount of assets, liabilities, and equity in the period of the change, please. Disclosures. First of all, tell me the nature of the change, the amount of the change, and if the amount of the effect of future periods is not disclosed, because estimating such an effect is impractical, you must disclose such fact. So you must tell me, what is the change in the current year plus future periods, please? And all I'm saying is that last point, if you cannot determine the future periods, then you must disclose the fact that it's impractical to do so. Right, so we've covered some of the basic disclosure theory. I will try and do an example with you a little later where we talk about a practical application, maybe using some PPE, where we split up and say, this is what it looks like using cumulative catch-up versus spread method, just to give you a practical working of it. Thank you.